All right, Marcus here, and I need you to lock in for the next few minutes because silver didn't drift lower. It dropped hard, about 8% in a very short window, and the trigger wasn't a headline, it was plumbing. The exchange raised margin requirements, and the market had to fund it. Source: AP News. That matters to you because when the move is driven by funding mechanics, it doesn't stay inside silver. It leaks into liquidity, positioning, spreads, and ultimately what investors can actually settle when stress shows up. Not a meme, not a rumor, not just a chart move. If this isn't speculation, what is it? Here's the balance sheet translation. A standard COMEX silver futures contract controls 5,000 troy ounces. Source: CME Group. When silver was trading around $80 per ounce and then fell roughly 8%, that's about $6.40 per ounce down. $6.40 x $5,000 ounces, $32,000. So a move that looks like 8% on a chart can become a five-figure cash problem in hours because futures are a finance position. Verdict: this was a funding event first and a price event second. By the end of this video, you'll understand what this move signals under the hood, why headlines miss it, how to position structurally. Most people miss this next part, and I'm going to frame it around three questions. Don't answer them yet, just hold them. First, who suddenly needed cash right now? Second, who had silver exposure but didn't control settlement? Third, if this is funding stress, what breaks next? Spreads, inventories, dealers, or volatility? We'll answer all three before the end. To understand what just happened, you have to separate silver into two layers. The first layer is financial exposure. This is where most participants operate. Futures, ETFs, options, leverage, synthetic exposure. It's liquid, it's fast, and it's mostly mark-to-market. And critically, it's margin-dependent. The CME clearing advisory for late December showed the COMEX 5,000-ounce silver futures contract margin rising from $22,000 to $25,000 for certain accounts. Source: CME clearing advisory. That is not commentary. That is the mechanism. The second layer is settlement reality. This is custody, deliverable supply, and inventory that can actually satisfy the contract. And the contract itself is explicitly tied to 5,000 ounces of deliverable silver meeting exchange specifications. Source: CME Rulebook. Here's the key point. In calm markets, Layer 1 and Layer 2 feel aligned because most participants never take delivery. Positions are rolled, hedged, netted, but in stress, that alignment breaks. Paper exposure gets forced to unwind while settlement constraints suddenly become visible. This isn't a flaw, this is the design. But we're still not answering the three questions yet. Because the chain of stress matters more than the label. Start with policy and liquidity conditions. When financing costs remain elevated across the system, leverage becomes fragile. Positions that looked safe under calm liquidity suddenly become unstable when collateral demands rise. You don't need a dramatic policy announcement. You just need positions that were too large relative to available liquidity. That leads to the second step: leverage behavior. Leverage is not conviction, it's math. When you hold futures exposure, the notional value is massive compared to posted margin. When the exchange raises margin requirements, participants must either post additional capital immediately or reduce exposure immediately. There is no third option. That's why margin increases often behave like a trapdoor. And we know margin changed in this case because CME officially published the margin adjustment notice. The third step is forced selling. Reports indicated that silver futures dropped roughly 8% after the margin increase announcement. Source: AP News. That's not primarily a silver demand story, it's a leveraged positioning story. Next comes dealer behavior. When volatility increases, dealers and liquidity providers widen spreads and reduce the size they are willing to trade. They protect their balance sheets first. That's when the difference between exposure and control becomes visible. Having a position is one thing. Being able to convert that position into settlement without friction is another. And then comes the final step, volatility expansion. Once forced selling begins, the feedback loop becomes mechanical. Price drops trigger margin calls. Margin calls trigger more selling. More selling expands volatility. Just margin math meeting crowded leverage. If you think this is just a price move, you're missing what it signals for the rest of the system. We've seen versions of this pattern across markets before. Stress rarely announces itself as a crisis. Instead, it shows up as sudden collateral demands, widening spreads, abrupt volatility spikes, and sharp moves in the most leveraged expressions of a trade. Silver sits in a unique position because it intersects several structural forces at once. Retail speculation, industrial demand narratives, futures leverage, and physical settlement constraints. That combination makes it extremely sensitive to liquidity shocks. And here's the uncomfortable part. The lesson wasn't learned, it was postponed. So here's how you position. 3 asymmetric principles. First, increase liquidity control. If your position depends on constant liquidity to survive, you don't control the position. Liquidity control means structuring exposure so you are not forced to sell when collateral demands change. Second, reduce counterparty distance. The more intermediaries between you and the asset, brokers, clearing layers, ETF structures, the more opportunity exists for exposure to diverge from ownership during stress. Shorter counterparty chains reduce failure points. Third, preserve optionality over leverage. Optionality means you can wait, you can respond. You can adapt to market conditions without being forced into a decision. Leverage removes that flexibility at the exact moment it matters most. No trade calls, no price targets, just structural positioning. If this move is part of a broader stress cycle, there are several signals worth watching. First, additional margin increases from exchanges during volatility reviews. Second, larger intraday price swings that suggest forced positioning rather than new information. Third, widening spreads and thinner liquidity in metals-related instruments. Fourth, choppy ETF flows and redemption activity that signal unstable positioning. Fifth, higher cross-asset correlation, where multiple markets begin moving together. These aren't healthy system signals. They are early indicators of stress building beneath the surface. Here's the weekly structural checklist. Reduce concentration risk, fix duration or time lock exposure, improve custody and control of your assets, strengthen structural diversification. His is not a trade. This is insurance. Now remember the first question I asked earlier. Who suddenly needed liquidity? The answer sits directly in the margin structure. When margin requirements increase from $22,000 to $25,000 per silver futures contract, the system demands cash immediately. Participants who cannot meet that requirement must reduce positions. That's where the speed of the move comes from. Now the second question, ownership versus exposure. Many investors believe they own silver when in reality they hold leveraged financial exposure dependent on brokers, exchanges, and clearing structures. Under normal conditions, that difference doesn't matter. Under stress, it matters a lot. This is where the structure connects. And now the third question, what breaks next? A margin-driven drop in silver does not automatically mean systemic crisis, but it does reveal where fragility exists, crowded leverage, thin liquidity buffers, and positioning that assumes markets will always remain smooth. When those assumptions are challenged, stress rarely stops at the first asset. It moves through the financing chain underneath the system. So I want you to drop a comment below. Forced choice. A. Liquidity-driven correction. B. Settlement-driven stress. If you got value from this, subscribe and share this video with someone who thinks an 8% move in hours is just market noise. This is education, not financial advice. The only question is whether you act while exits are open. Stay sharp, stay informed, stay ahead.